Exchange-traded funds, more commonly known as ETFs, are loved by those learning how to start investing and experienced investors. Traditionally, ETFs provide investors with diversification, peace of mind, and healthy returns. Let's find out what an ETF is, how they work, and whether you should invest in one or not. First off, what is an ETF? An exchange-traded fund is a basket of securities that typically track an index, such as the S&P 500 or Nasdaq Composite. ETFs have all the good qualities of mutual funds without the account minimums or high management fees. They are available on exchanges and trade just like stocks. There has been a massive shift into exchange-traded funds since the 2008 financial crisis. Investors realized that their mutual funds couldn't protect them on the downside, even though they were paying high fees for active management. Why pay advisors to manage a fund when you can just invest in an ETF that nets better returns and fewer fees? Let's continue to explore the magic of exchange-traded funds. How exactly does an ETF work? An ETF provider such as iShares or Vanguard selects individual securities to put in the exchange-traded fund they're creating. The provider determines the type of weighting for the ETF, market cap weighted, equal weighted, or fundamental weighted. The most common is the market capitalization weighting, where the stocks with the highest market caps will have a higher allocation in the fund. Investors can buy shares of that fund just like they'd buy individual stocks. ETFs have their own unique ticker, which is sometimes something funny, like ProShares' pet care ETF, PAWS. Furthermore, investors buy and sell the ETF during trading hours on an exchange, and the price of the fund changes throughout the day. Let's talk about the different types of ETFs. Number 1. Stock ETFs. This is a broad category of ETFs where many different kinds of stocks can be under the same roof. For example, the S&P 500 is composed of several different sectors of stocks, such as technology, consumer staples, and energy. Stock ETFs can provide diversification that protects investors when a certain industry gets smashed. For example, energy could be getting killed, but you may still be in the green if technology and financials are rising. Number 2. Industry ETFs. Industry ETFs, also known as sector ETFs, are baskets of funds specific to an industry such as technology, healthcare, or financials. These ETFs allow investors to bet on specific sectors that may be ripe for growth. Number 3. Bond ETFs. Bond ETFs are often considered lower risk than stock ETFs because they are less volatile. Bond ETFs do not have a maturity date like individual bonds. Investors rely on bond ETFs for regular cash payments and protection during high market volatility. Recently, bonds have become less desirable due to interest rates being near zero. Historically, capital flows into stocks and out of bonds when interest rates are low. Number 4. Commodity ETFs. Commodities are bulk goods and raw materials, such as grains, oil, and metals. While they are a good way for investors to diversify their portfolio, commodities are vulnerable to many unpredictable variables, such as strange weather patterns, pandemics, and man-made or natural disasters. Number 5. International ETFs. Another way to diversify your US exposure is to allocate money abroad in international stock or bond ETFs. Some of these funds include a mix of US and international companies, while others are solely international. There is certainly a home team bias when it comes to investing, but investors will miss out on gains if they only invest within their borders. Number 6. Inverse ETFs. Inverse ETFs enable investors to bet against the market or an underlying index without having to short the stock. These funds are composed of various derivatives to profit when the underlying benchmark declines in value. Number 7. Currency ETFs. A currency ETF tracks the relative value of a currency or a basket of currencies. Similar to commodities, investors may use currency ETFs to get exposure to markets that otherwise would be intimidating to navigate. Investors often use currency ETFs to hedge against exchange risks. Number 8. Leveraged ETFs. These are aggressive ETFs that use leverage to provide multiple times the return of the index they track. For example, TQQQ, or triple QQQ, is triple leveraged to deliver 3 times the daily return of the Nasdaq 100 index, or QQQ. So if the Nasdaq goes up by 2% today, TQQQ will go up 6%. However, losses are also amplified by 3 as well. Now that we covered the different types of ETFs, you may be wondering, what are the benefits of exchange-traded funds? Investors flock to ETFs for good reasons. Let's discuss a few benefits you may consider. Instant diversification. Diversification is a healthy part of any portfolio, and ETFs make it easier than ever to diversify. As we showed in the previous section, there are many types of ETFs to accommodate any investing strategy. The shift into passive funds sparked demand, and the ETF providers responded with the supply. Now, instead of just an international ETF, there are specific kinds, such as developed, emerging, and frontier international ETFs that apply down to the country. There are levels to diversification. No minimum investment. ETFs' cousin, the mutual fund, often requires minimum deposits between $3,000 to $10,000 to begin investing. Since ETFs trade like stocks, there's no gatekeeper to keep you from putting your money to work. Lower costs. On top of mutual funds' minimum stake, they require high management fees because they are actively managed. This means that you will pay somewhere between 1% to 2% for an advisor's oversight on the fund. Most ETFs are passively managed, so their fees are much lower compared to their actively managed counterparts. However, some ETFs are actively managed, which means they are going to be more expensive for investors to carry in their portfolios. It's important to read the fine print and consult with a financial professional before you invest in an ETF. Depending on the type of ETF, annual expense ratios can be as little as 0.03. This means that you will pay the brokerage $3 annually for every $10,000 you have in the fund. Liquidity. Since ETFs trade like stocks on an exchange, they can be bought and sold on the same day. They have real-time pricing, unlike mutual funds that reveal their price at the end of the trading day. Having liquidity may give investors peace of mind during times of high volatility. Tax benefits. Owners of ETFs control when they execute taxable events, which typically occurs only at the sale. When funds are exchanged within the ETF by its provider, only shares are transacted and never cash. This allows ETFs to avoid capital gains tax when securities are redeemed or created. Owners of mutual funds are subject to their advisor's priorities and not in complete control of when taxable events occur. While their advantages outweigh their disadvantages, it is still important to understand the shortcomings of ETFs and how to mitigate their downside. Is there such thing as too much diversification? While some investors welcome the multi-sector diversification of large index funds, others don't want to be weighed down by underperforming industries. Investors with a higher risk tolerance may try to maximize their gains by choosing the individual stocks or sectors that lead the index. Finding the right balance of diversification is key to optimizing your portfolio. Learn more on asset allocation here. Infrequent rebalancing. ETFs track indexes that are often market cap weighted. This means that the stocks that rise in price carry more weight in the index, resulting in too much exposure to particularly overvalued stocks and not enough allocation to undervalued bargain stocks. Again, some may see this as a benefit because they benefit from the winners and they get less exposure to the losers. However, this may violate their initial reason for getting into ETFs, diversification. So let's summarize what we've learned about exchange-traded funds. ETFs are a useful instrument for any dynamic portfolio. They allow you to execute strategic plays in the market without casting diversification to the curb. Today, exchange-traded funds remain a fan favorite among both new and experienced investors. They are relatively safe and offer immediate diversification. If you liked this video, then make sure to hit the like button, subscribe, and join us every week as we break down personal finance topics in plain English.